even the midpoint in terms of AI spending cycle, I would still put us in the first leg of it. And that is because most of the spending, as we know, has been by hyperscalers and technology companies. And we're starting to get a broadening out of other industries really map out their spending and investment plans. And I think it's going to take probably a couple quarters before everyone wants to know how much is going to get monetized and what it's going to look like. A couple quarters before we really have a great sense. But the number of use cases that are coming up from companies across many industries is increasing even by the week. Think about conference season over the last couple weeks. There were a lot of use cases discussed by everything from industrials companies to consumer companies. And I know even in my work on a day-to-day basis, I have managed to become much more efficient in company analysis as a result.
Do you think you mentioned those hyperscalers, and they are spending.
Yeah.
And you listen to their conference calls, it suggested like they intend to keep spending.
Definitely.
And yet also this tension where I felt like last earnings season, we'll see what happens in the next one, you had at least some investors kind of pushing back a little. Show me the return. Would you expect that pushback to continue?
I mean, I guess I would make the same argument with any kind of infrastructure investment, whether we're talking about like digital infrastructure in this case or physical infrastructure. Of course, it takes some time of spending in order to create the situation or the framework that allows growth to happen. You can't expect a city to flourish if it doesn't have roads and sewers and public transportation. And I'd say the same thing. I think these hyperscalers know what they're doing. They already feel like the spend is a small amount of their potential total return. And so they are offering us, just as I was mentioning these other industries, use cases of things that are working. So look, I think this is a space that you want to stay long in. And I would use opportunities and pullbacks, like particularly on the hardware side, to kind of re-up your positions, and I think there's more opportunity on the software side now as well.
Kate, just to close us out, to bring together two of those themes real quick, if corporate tax rates go up, does that curb that spending?
I don't think it makes a single change. If you look at the corporate tax cuts that took place in 2017-18, it only contributed about 40% to net margins, 40 basis points to net margins over the course of the subsequent years. Companies, especially U.S. large cap companies, are outstanding at managing their tax burden. And that's a really polite way of saying—
I was going to say, that's very diplomatic.
Yeah, don't bet against U.S. companies and their ability to deliver on the bottom line.
Kate, thank you so much.
Yeah.
Appreciate it. Good to see you. We're just getting started here on Market Domination. Don't go anywhere.
Meta unveiling a new mixed reality headset at its annual Meta Connect event. And Yahoo Finance's very own Dan Howley joins us with more. Dan.
That's right. So they unveiled this new Meta Quest 3S. It's basically a entry-level version of the Meta Quest 3, and they got rid of the Meta Quest Pro, which was the super high-end version, and got rid of the Meta Quest 2. So this is supposed to be your entry point into AR, VR, mixed reality, whatever you want to refer to it as. Starts at $299. It'll start shipping next month. It says it has the same chip as the Quest 3. It's a little bit bulkier and it doesn't have as wide of a field of view, but you'll still be able to do things like play VR games and then see the world in front of you, which is mixed reality. This is kind of a way to help juice sales of AR, VR headsets. But you know, I don't think this was the most exciting announcement from the show. In fact,
what was?
The updates to the Ray-Ban Meta glasses were actually really impressive. That's been a surprising
Why,
hit.
Dan? How so?
New AI, and basically they're taking the kind of AI features that you'd normally get on your smartphone, and they're adding it to the glasses. So you'd be able to look at something, say you're walking down the aisle of the grocery store, say, what can I make for dinner? And it'll look at what's around you and tell you what you can make. Or if you see a famous landmark, you can ask for information about that, and it'll tell you that kind of information. They also are the only non-cowardly group of tech companies, or non-coward tech company, to release a piece of technology with translucent late 90s, early 2000s styling. So it's got that see-through kind of design. Apple, Google, get on that. I just want to be able to see through on the technology. Meta's the only one doing it right. And then they also have this new Orion headset that they showed off, a prototype of their future kind of plans for AR with, I mean, it's supposed to look like a pair of glasses. It looks chunky, and it's clearly not ready for prime time, but you'll be able to see holograms through it while just wearing it like a pair of glasses. It seems really cool. The Ray-Bans are cool because you can use them as sunglasses. That makes sense. People want to wear sunglasses. A lot of people don't want to wear these, like just getting a pair of glasses all the time.
Yeah.
I mean, you literally get eye surgery to not have to do that. I have not yet, but
yes, we're used to wearing the glasses. Maybe we're the target demo. I don't know.
Maybe.
Sticking to tech hardware, let's talk about Apple for a minute here, because there were some analyst commentary chatter around the reception that the iPhone 16 is getting.
Yeah, so this is about the lead times for iPhones, and basically what that means is how soon you're able to get it after you order it. Now, the longer the lead time, that usually means the more demand, because Apple's trying to get this stuff shipped out to people, but the lead times, according to different analysts, are shorter than normal, than for the iPhone 15 or 16, and in some cases, multiple generations beyond that. And so what that could tell us is out of the gate, people aren't exactly going crazy for these new phones. The other piece of this could be that Apple was loud and clear that Apple Intelligence is not available out of the box, and so people may be holding off until that's fully rolled out, in the coming weeks and early into next year.
It could also be, Dan, though, I mean, I get it, investors, you're hungry for like any data point and get your hands on it, so we focus on wait times. But could it also be, we don't know the supply side of the equation.
Yeah.
And if I don't have that, I don't really have clear line of sight. I mean, I actually might have to wait for Tim and Luca to get on an earnings call and tell me how things are.
Yeah, I think that's the big thing.
Yeah.
I think the other big thing is this is a tiny window when it comes to the life cycle of these phones. So, the holiday season is much more important than the lead times right after the phones actually come out. So, I mean, it is, like you said, everybody wants a data point. It's an interesting data point when you look at the prior performance, but look, what's going to really matter is when it comes down to the holiday season. And again, maybe when Apple Intelligence takes off, people start buying these like gangbusters.
We shall see. Thanks for that. Howley Intelligence. I think we should rename the segment.
Copyright right there. Yeah. Don't even try to steal that.
Thanks, Al. All right, now it's time for some of today's top trending tickers. You can scan the QR code that you're going to see below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, taking a look at shares of NVIDIA. Shares rising as the market for AI hardware and software expected to grow to as much as $990 billion by 2027.
Nearly $1 trillion, Julie. That's where we're headed.
Let's round up. According to a new report by Bain & Company, this is the report that I alluded to a little bit earlier that looked at this 40 to 55% annual growth pace here that they're projecting. And then Jordan my Jordan Klein over at Mizuho sort of picked up on this and talked about the implications for the likes of NVIDIA and some of the other companies in this ecosystem.
Yeah, it's interesting that dynamic. We've talked a lot about big tech spending on AI. Investors may push it back, but we just spoke to Kate Moore at BlackRock, who sounded optimistic that spending would continue.
Yes.
Early days.
What's also interesting is the ripple effect that we are seeing today from this optimism with the utility companies. Vistra, one of the companies that has benefited from all of this talk about data center build out, the need for utilities to power that. It's the best performer in the S&P 500 today.
It's up
But guess what?
200% this
It's the
year.
best performer this year. It has outpaced NVIDIA pretty handily. So
move.
that's kind of another way that we are seeing that AI optimism play out.
Yeah, for sure. Look at that chart. Moving on to the next trending tickers, Amgen shares sliding after the biotech company posts disappointing results from 2 drug studies. So this one was interesting. Under some pressure here, drug maker offers updates from its immunology and rare disease development pipeline. Investors obviously not thrilled and happy about that. I was reading it, Julie. It sounded like positive top line results, but clearly the street looked at this not underwhelming.
Yeah, and it's also all relative when you're coming to talking about these kinds of drugs, because I was seeing some chatter here that one of the drugs, which is a treatment for atopic dermatitis that they were running a study on, there's an existing product that's already on sale from Sanofi and Regeneron called Dupixent, and this Amgen therapy was seen as less effective than that one, and that one's already on the market. So when you're sort of comparing what's out there to what they're trying to develop here, that I think plays into the equation as well. And to that point, some shares of companies that are working on competing products have been rising in today's session.
All right, moving on. It is the latest edition of our series, Goodbye or Goodbye. We are taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're looking under the hood of electric vehicle makers. I'm here with Alonso Munoz, Hamilton Capital Chief Investment Officer. Good to see you. Thanks for coming in.
Good to be here. Thank you.
So your pick today, it's an interesting one, your Goodbye, because it's one that a lot of folks on Goodbye or Goodbye have not liked, and we're talking about Tesla. Now, Tesla, of course, has lots of fans out there. The shares are up in the neighborhood of 5% or so over the last year. So let's talk about why you like it. First of all, you are buying into the autonomous driving story that the company really has said, if you're going to buy Tesla, this is why you're going to buy it.
Sure. How about that chart? So autonomous driving is a core focus for Tesla in the next phase of their growth stage. And so we're looking forward to October 10th, which is the robo-taxi, and seeing how Tesla executives portray the next phase of Tesla growth in automation. We also see that Tesla has millions and millions of cars on the road, not only here, but all over the globe. And so the ability to transition these cars into autonomous vehicles is super compelling for us.
You know, the autonomous capabilities of the cars right now has been under scrutiny by regulators.
Sure.
And there are robotaxis that are already on the road from the likes of Waymo.
Sure.
So how do you think about Tesla with those two sort of potential challenges?
Sure, Julie. I'm glad you brought up Waymo. So Waymo competitor, they have cars on the streets, and folks can get in and take get from point A to point B without a driver. But the advantage that Tesla has is the data. They have vast data, much more than Waymo, to train their vehicles. And we see that as a catalyst for getting this out and rolling it out not only in cities, but in rural areas across the states and the globe.
Gotcha. All right. Let's also talk about one of the other catalysts you're looking at. That's improving financials. What's going to drive those improving financials?
Well, we always talk about margins. Analysts love to critique the margins and the decreasing margins over the last couple of quarters, but the revenues are strong. They have good revenues, they have a strong balance sheet, and they have a lot of cash to deliver on their product roadmap. So that's something that gets us excited. And next week, hopefully on the second or third, we get third quarter deliveries.
Right.
We expect 460 to 470,000. That would be an upside surprise, and that hopefully leads to increased sales. But it shows that Tesla is delivering on their promise, which is getting cars out there.
And then finally, they're not just selling cars, as we know.
That's right.
They do other stuff, including put solar panels on people's houses,
That's
which
right.
doesn't get a lot of talk. They make batteries as well. So, you're looking at that sort of diversified revenue stream.
Well, we are. It's not just a car company. We see it also as a technology company, as a software company, but also an energy company. They have their energy storage business and their solar. Second quarter energy revenue was explosive. It was exceptional. And that's something that gets us excited away from just the selling of vehicles. And the auto industry has had some struggles over the last couple of years in this macro environment, but also with higher rates. So their diversified business lines and revenue there gets us very excited.
And then let's talk about, we always like to talk about a risk too, something that you like. And I actually alluded to it earlier, and it's regulation potentially here. So talk to me about how you're thinking about that.
We do. So regulation and policy. And I think after the robotaxi event, the focus will be on how do we get these cars on the streets without drivers, and how do we make sure that these cars are safe going by our kids' schools, hospitals, on the highways. And so we're going to really focus on what policymakers at the federal level, but also the state level, think about this rollout of autonomous vehicles over the next couple of years.
Also, another quick question, not so much about policy, but about politics, because the CEO of Tesla, Elon Musk, has hitched his wagon very explicitly to former President Trump. What happens if Trump doesn't win?
Yeah, it's interesting. The tariff conversation is, I think, across the board. And we're going to analyze and see how tariffs here in the States, but also internationally, affect revenue per vehicle. And I think Tesla's going to have to adapt. Obviously, he's a outspoken CEO, and he, we watch his tweets on X. And so it's an interesting company to track. If you look at the stock chart, you pulled it up, it's been a roller coaster of a ride. But for investors that want to participate in the transition to electric vehicles, this is the way to do it.
All right, let's talk about the way you don't think it is to do it, and that's with Rivian. And a lot of people agree with you, right? The stock is down more than 40% over the past year. But let's talk about why here. The company needs cash, right? They have talked about that.
Absolutely. So they need a lot of cash. This is a scale industry. And very recently, this summer, they partnered with Volkswagen. They got $5 billion to roll out the next sort of phase of their growth, which is lower cost vehicles. And so this is something that we're looking at. It's an unprofitable business. They lose money for every car that they make. And we're in an environment where consumers have preferences and there are options. So someone that wants to get into an electric vehicle, doesn't have to go to Rivian. They can go to other options, and Rivian competes with Volkswagen as well. So it's sort of an interesting take.
True. And then in terms of the production of the vehicles, they've had some sort of fits and starts.
I do. I think this is sort of a big challenge for them. Last month they paused the production of their electric delivery vehicle, which are the vans that they make, commercial vans for Amazon, one of their biggest customers. And so this is just one more thing to add on top of the negative narrative for Rivian. But also we've seen decline in production last quarter, specifically as we compare that to the first quarter and the fourth quarter of last year. So we're looking at this, and it looks like they're going to meet their targets, but this is just something that makes us uncomfortable.
Gotcha. And then finally, you said they're rolling out that lower cost version, but there aren't that many Rivians, different models of Rivians to buy.
That's right. They couldn't come soon enough. So right now they have the luxury SUV and the luxury truck, and it's very, very expensive. If you look at their commercial vans for businesses that are making a decision to purchase these vans as well, they're expensive relative to what's out in the marketplace. And so we see this as a headwind for Rivian, and they have to execute. And some of these production challenges that we're talking about make point number 3 even more difficult. They have to get these vehicles out to market, to get sales, to drive revenue, to hopefully become a profitable company, and they expect to do that by 2026. We don't know if they're going to make it.
Right. Well, let's talk about what could turn around. Maybe doing all of those things, cost cutting, improving financials. They got that infusion from Volkswagen, as you said. Maybe that will be the bridge.
They did. So that's the key. If they can lower their cost, if they can leverage their partnership with Volkswagen, and they can get production, crank production up, and get cars on the streets, I think that would be really positive for Rivian over the long run.
All right, Alonso, thank you so much for being here. Really interesting for Goodbye or Goodbye. And thank you so much for watching as well. We'll be bringing you new episodes at 3:30 p.m. Eastern. Josh?
The House of Mouse is deadbolting its doors. Disney officially cracking down on password sharing, making it tougher for individuals to share their Disney Plus logins with friends and family. Here with more is Yahoo Finance's Alexander Canal. Allie.
Yeah, Josh, unfortunately, Disney Plus has now fallen victim to this password sharing crackdown that we've really seen across the board. Also, Netflix, Warner Brothers Discovery announcing their own password sharing crackdowns. Netflix has been particularly successful in this, which has prompted some of these other streamers to echo it. Now, according to Disney, users who share an account with someone outside of their household can add an extra member for $6.99 per month for the Disney Plus ad tier, and then $9.99 a month for the ad-free version. These are both at discounted rates. Now, Disney defines a household as, quote, a collection of devices associated with your primary personal residence that are used by the individuals who reside there. So again, if you are that account holder, you can add one extra member. The exception, though, is that if you subscribe to the Disney bundle, which also includes ESPN Plus and Hulu, you cannot add that extra member. Now, what's interesting here is this comes just ahead of planned price hikes that will be hitting the streaming giant in October. That is just ahead of the debuts of Agatha All along with the movie Inside Out 2 that will be coming to the Disney Plus platform in October as well. We've seen price hikes really across the board as a lot of these companies really search for long-term profitability. We saw Peacock hike prices in July just ahead of the Paris Olympics. Max, same thing, raising prices ahead of the Game of Thrones prequel, House of the Dragon. So it really seems like they're trying to strategically roll out these password sharing crackdowns, these price hikes ahead of key programming. So we'll see what other streamers get hit, but this seems to be a trend that's not going to be going away anytime soon.
All right, thank you, Allie. Appreciate it. The Dow and S&P 500 pulling back from record highs, but for the month, the stocks are bucking the historical trend of weakness. The third quarter has been volatile, and with earnings season and the presidential election around the corner, there's more uncertainty ahead. We're looking at how to navigate this in the options pit, sponsored by Tasty Trade. Brian Overby, senior options strategist, joins us now. Brian, it's good to see you. Maybe start big picture for us, Brian, because you look at these markets. Fed last week delivers that supersized cut. We're kind of drifting here. You say to you look at these markets, Brian, you say, seems kind of nervous to you.
Yes, I guess my outlook would be bullish but nervous. And one of the biggest indicators to me was what actually happened after the Fed had the 50 basis point cut. We saw the markets actually close down on the day after that, and there was a lot of nervousness. A lot of people in the marketplace basically thought to themselves, well, if they're willing to do a 50 basis point cut, there must be something, lurking in the economy that they're scared of. And then all of a sudden the market's closed and the futures market took over, and everybody collectively decided, well, you know what? If they're willing to go 50 basis points, that must mean they're not that worried about inflation. And that kind of became the story. So then the focus went from inflation to jobs, and the market took off. And so as long as the economy feels we're doing okay in the job front, then the market decides that it wants to set new highs. But there's so much volatility in the marketplace. It's kind of hard to decide exactly where the market wants to go. And we got a little bit of complacency in that we actually look at the VIX index and we see that trading down around 15% in September, but it's been all over the place. And so good news, bad news situation, but I think overall the market's extremely nervous until we get to the election.
Well, and you know, sort of, if you look at the VIX seasonality chart, you can kind of see that. That's the chart that you highlighted for us. If you look at the VIX, now this is the VIX, sort of the average of the VIX over the last decade or so. And what we tend to see is two peaks in volatility in the year. One is in March, and the other one comes, it looks like they're eyeballing it in early November. And what's interesting to me, Brian, is we keep talking about how terrible September is, but that's not when volatility tends to peak. And the other thing that's interesting to me is that this chart is for 10 years that included election years and non-election years, but we still saw it peaking in November. What do you make of it?
Yeah, well, the biggest thing about the VIX and the fact that September and October just seem to be always the most volatile months. There's no real rhyme or reason behind it, and it doesn't necessarily have to be an election year for that to happen, even though the numbers have shown that in election years, usually 1 month prior to the election, you get the highest spike, or I'd say the highest average volatility, and that happens to be October too. But if you just go back and you just think about all the big downturns we've had in the markets, they're usually on a Monday in October. No real rhyme or reason to it, but it's a fact. So when I look at the markets and I'm going into October, I'm always going to keep that in the back of my mind on the way that I'm trading. So a lot of the trades that I'm doing inside the options trading world are neutral to bearish on the marketplace. And I really want to get that one big unknown event, which is the election, out of the way. And once that happens, considering where the Fed has been leaning as far as interest rates are concerned, that can really be a catalyst to make that market drive higher as we get into the new year.
Brian, let's talk about some trades. One you have more long-term would be D.R. Horton. Walk us through it.
Well, the biggest thing about D.R. Horton is obviously when the Fed cut the rates, it was a surprise to the market. Well, even though it was about a 50-50 chance they were going to go 50 basis points or 25 basis points, I still think the market in general was surprised by that. And ultimately, that drives interest rates down on mortgages. So the housing market was anticipating this rate cut, and it ran up into that announcement by the Fed in the Fed meeting. And now they're even talking about more rate cuts going into next year. And the market has had a little bit of a nervousness about sell the rumor or buy the rumor, sell the news scenario. And I think that's happening a little bit today in the home builders. We see D.R. Horton down a little bit, but I want to take an opportunity then to just get long some of those lower valued stocks. As a matter of fact, a lot of the stocks in the home builder sector are trading at decent PEs or decent valuations relative to the rest of the marketplace. So things can only get better if you think about as far as interest rates and the housing market. So I'd like to take that opportunity to go on out and actually buy a long call option, and we're going to go deep in the money, and it's going to be a surrogate for actually owning the stock. So if you're thinking I'd like to buy 100 shares of D.R. Horton, well, it's a fairly expensive stock to buy 100 shares of. But if we go out until May, we're going well into 2025, and we go deeper in the money, we're going to pay for that option contract. But guess what? It gives you a lot of exposure to the actual stock without all the risk. As a matter of fact, you're looking at putting up about 19% of the total price to actually buy the stock. But As the market goes up, you're getting about 80% of the representation of actually owning the stock outright, of actually owning 100 shares of stock outright. So in my mind, this totally goes along with the I'm bullish but nervous situation. We had a big run up in the home builders. I would like to participate, make sure that I don't miss out on the next big run up, but I don't want to have all the risk of actually owning 100 shares outright.
Brian, thank you so much for the trade suggestion and the options analysis. Appreciate it.
Thank you.
Stick around. We've got more market domination coming right up. Piper Sandler downgrading Tyson from neutral to underweight. The note highlighting heifer retention as a potential risk to near-term supply. You always like to read about heifer retention. They actually think heifer retention could improve because they were talking about rebuilding herds here. But basically, pricing for different proteins, according to this note, it sounds like it's going to get worse.
I think that's a good sum up. You got some, some commentary on beef. You got chicken. Had some things to say about pork. Some risk in pork too from record hog herd health levels. There's something I haven't said on air before.
Hog herd health levels.
Say that 10 times fast. Target goes to 50. Average target, by the way, in the street is more like 64. They did note to their clients there's some risk this call. They pointed out livestock supply favorability in terms of pricing, better economics, strong consumer demand, but obviously that is not their base case. They're a sell on this one.
Yeah. You know who sells a lot of chicken, a lot of beef? Costco. Yeah. We're going to talk about that one right now.
What a segue.
Costco is expected to report another bulk-sized quarter when it reports its numbers here. The wholesaler will report fourth quarter earnings after the bell on Thursday with jumps in same-store sales and e-commerce expected. Our next guest says it is clearly gaining market share. We're looking at how to play wholesaler stocks and some of the other warehouse plays with the Yahoo Finance Playbook. Joining us now, Michael Lasser, UBS U.S. Hardline, Broadline, and Food Retail Analyst. Michael, it's good to see you. So when it comes to Costco here, what are some of the highlights that you're looking for in that report?
So the highlights that we're expecting in the report are, number one, very healthy growth in the membership fee income. that is a critical driver of the company's profit and loss statement. It represents about 50% of its total income. So monitoring that metric is important. Also, how its margins are performing. What we look at is a key metric called core on core gross margin, which is a indicator of how its profitability on a particular item is doing this year compared to the same period last year. That had been going up in the more recent quarters. It's been going down a little bit as the company invests to try and continue to offer value to its consumers. Those are going to become some of the key metrics that the market's looking for, especially given that it already provided the heart of the sales that will report this quarter.
And Michael, is Costco taking share here in the U.S., and if so, from whom?
So Costco is without question taking market share. Costco is taking market share from a vast majority of the players in the market. That includes conventional grocery stores, specialty retail stores, mall-based retailers. What is happening is the consumer, A, is attracted to the value-quality equation. It sells very high-quality products at inexpensive prices. And B, the consumer is consolidating trips and spend at particular retailers. Costco is uniquely well-positioned to benefit from both of those trends.
I'm also curious what we're going to hear in terms of the fee increase. And I believe it was effective September 1st. So it wasn't in the quarter that they're about to report, but maybe we'll get a little bit of a commentary on how things are looking so far in terms of whether it's affected memberships at all. What do you think?
Here are the two things to watch in regards to the fee increase. Number one is how is retention in response to the fee increase? And historically, Costco has experienced very stable and strong retention trends in the 90% range. We expect that to continue, even if it does ease off ever so slightly. And number two, how is it using this additional pool of profits that it's going to be able to accrue to increase the value proposition to its consumers? In many cases, and oftentimes, Costco will take the anticipated benefit of something like a fee increase and begin to lower prices even before that starts to roll into its income statement. So how it's treating that P&L benefit will be important this quarter.
Michael, another name I want your take on, AutoZone. Reported results this week. Looks like Q4 same-store sales did miss. Stock's up, though, about 20% this year. What's your take on that name, Michael?
So the reason why the stock is up like it is because the market is gravitating to sustainable growth stories. If we're sitting here a year from now, there's a lot of uncertainty over the next 12 months. And we could walk through those factors. But what the market is saying is that it has a higher degree of confidence that AutoZone will continue to grow its earnings in light of how it's positioned and in light of the market that it serves, more so than other retailers. As a result, its multiple has expanded, even as earnings have been ratcheted a bit lower more recently due to some currency headwinds. We like AutoZone. We continue to believe that it's well positioned to outperform.
And Michael, I want to ask you a broader question as well, because it affects many of the companies potentially in your coverage universe. I'm wondering how you're thinking about sort of inventory management and pricing right now. There are a couple of things that could affect that that are upcoming: a potential port strike, which could affect supply of goods. And then there's the threatened increase in tariffs if former President Trump wins re-election on a broad swath of goods. So, how are you sort of thinking, and I know this is very high level, because these are theoreticals, but sort of how are you thinking about how that could affect your coverage universe?
So by and large right now, retailers are very well managed from an inventory standpoint. That's one. Two, there are a host of uncertainties in the next 12 months. You highlighted a couple of them: tariffs, some global supply chain, the tax situation, because some of the tax cuts that were implemented in 2017, 2018 are set to expire at the end of the year. The overall uncertainty with the consumer being distracted from the election. On the other hand, there are some positives. Real wages are growing. Historically, that's been a key driver of overall consumption. Credit availability is becoming a bit more widespread, and interest rates are coming down. We take all of those factors into account. What we believe is that there are risks and opportunities on both sides. We think you need to be selective within the retail sector. As far as the specifics on the inventory situation, retailers have had a lot that's thrown at them in the last 5 years. We remain confident that the large, well-positioned retailers like a Costco, a Walmart, Home Depot, and Lowe's will be able to manage through it no matter what happens.
Michael, always great to have you on the show.
Great to see
Thank
you,
you for your
Josh.
time and those picks.
Good to see you.
We've got you covered with all the action following the closing bell, including the latest earnings report from Micron. Stay tuned for market domination overtime.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains.
We're on for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
There is the closing bell on Wall Street. And now it's Market Domination Overtime, sponsored by Tasty Trade. Let's see where the major averages ended the session. Here was a mixed day when all was said and done. The Dow faring the worst of the major averages, down by 0.7%. That's about 293 points. The S&P 500 pulling back by about 0.5% after closing at a record again yesterday. And the Nasdaq Composite, the one of the major averages in the green here today, but very, very slightly in the green. If you take a look at the equal weight index, you see it performing worse today than the S&P 500. So that tells you, again, just another way of slicing and dicing it. The tech was kind of the thing that was holding things afloat today. Small caps, by the way, were also underperforming. Let's take a look at the sector action here, because it was an interesting day in that regard. On the downside here, you had energy. We had oil pulling back a little bit. There's some news out of Libya that shows there might be production that might be loosening up and increasing there. So that was one of the things affecting it. Healthcare also lower. We talked earlier about some new test results pulling down Amgen shares, for example. On the plus side, we've got utilities and tech that have been besties this year, right? Because we have seen the AI news lifting both of those groups, of course, lifting tech for obvious reasons and lifting utilities because of the outlook for what it is going to do for energy demand. If you look at the year to date here, you've got utilities, communication services, a different flavor of that. Tech is also up 16.5%, but utilities far and away the best performers. We're going to talk more about that power demand behind data centers a little bit later this hour, Josh.
Thank you, Julie. The Dow and the S&P 500 pulling back from all-time highs. The Dow snapping a 4-day winning streak. And joining us now is Drew Pettit, Citi U.S. equity strategist. Drew, always good to see you. So Julie pointed out there, mixed day. Though, strategists quick to point out here, Drew, month to date, returns actually bucking, so far the month's traditionally, disappointing performance track record. What do you make of this market, where we are, where you think we're headed?
Yeah, so look, the big change was the Fed. So I think the Fed, and honestly, heading into the Fed decision, interest rates across the curve coming down gave people a lot more confidence to look through some potential softness in the labor market, maybe a little bit of softness in earnings, macro data, even the housing data today, out the other side to say, hey, the Fed isn't going to be as far behind the curve. That's okay. I can start positioning for the recovery. And we've seen not just the secular stories work, but we've seen some of the cyclical stories start to work, at least since the mid-July, interim peak.
I feel like, Drew, we have the conversation at this time before every quarter about how earnings are going to look, and that there's a little bit maybe of talk, things have peaked maybe in terms of the juice that could be squeezed for earnings. How are you thinking about that?
Actually, we don't think we've really hit that peak. When you start looking underneath the surface, you feel really good about secular trends. We get that. The growth stocks, they can probably survive any type of weakness. But when you start thinking about the cyclicals that are much more leveraged to the economy, when you look at their earnings, they already went through a recession. So economists talk about the world on a quarter over quarter basis, but when companies and we talk about stocks, we talk about it on a year over year basis. So we're still working off some easy compares, and we're actually improving off of those really low levels. So it's funny when we talk about the economy, but we talk about the market differently. We actually think we're on an upswing for some of the parts of the market that really haven't gotten much love over the past couple of years.
And what about the parts that have gotten a lot of love, Drew? You were out with some recent research where you talked about tech stocks in particular. We've been talking today about this AI research out of Bain and how that sort of seemed to give a lift to some areas of the market. But again, coming back to this idea of where we are in the earnings cycle, for tech, you say, we're looking at slowing sales growth. How's that going to play out, and what effect is that going to have on these stocks?
Yeah, so this is really interesting. Talk about a market of stocks and how all of their fundamentals have been very different. So the growth side of the market has had really strong growth. So it becomes the problem of, let's call it the law of large numbers. You're growing really fast. It's hard to keep that up forever. But when growth stocks see their sales decelerate, there's been points in the past where that has actually pressured their earnings. But what we're seeing a lot of, especially in certain themes, AI actually being one of them, the business models are a lot more mature that they can get more incremental earnings even out of lesser sales growth. So while we're not going to have runaway growth that maybe rips these stocks aggressively higher and drives massive growth outperformance, we think a lot of them can handle, some top line deceleration. But we want to be a little bit more picky within tech going forward.
Let me ask you, Drew, I'm curious about the election. How many questions you're getting right now from clients about that? We've had some strategists come on the show, Drew, and say, you know what? If you're an investor, long-term investor, look through it. Is that your advice?
Yes, to some extent, but honestly, you got to be wary of tail risks. So, yeah, I would say in the past week with Fed news being a little bit more topical and front and center, we've had a few less election questions, but what we've been focused on a lot is what are the tail risks? Because while it might seem like I'm talking out of both sides of my mouth here, we actually think a sweep on either side is short-term equity negative. You offset some of the good growth in tax policies from either candidate with some other questionable policies on the economic front. So we're talking about tail risks on both sides. We think investors should be aware of those. But again, back to you, it's like earnings, that's driving long-term market direction.
Yeah, and as you say, it's sort of conventional wisdom that gridlock tends to be better for markets, right? Not sort of one party being dominant. Drew, I want to go back to something you said that, we talked about tech, maybe seeing some slowing growth. You mentioned that there were some overlooked areas of the market where you would be looking right now. Where are those areas?
It's actually the cyclicals. And consumer, we've talked about consumer concern and consumer weakness for so long. But again, out the other side, we can actually see the consumer stocks and their earnings growth profiles recovering. Financials, another one, the rate setup getting a little bit better with the curve not as inverted. And then real estate, I think, has recovered really nicely. Those are our top 3 sector picks right now.
Drew, it's good to see you. We got to leave it there. Thank you so much. Got to get to some breaking earnings news now from Micron. We've been waiting for this one. The memory chip maker coming out with numbers that surprised to the upside. The share's up 9% here. Earnings per share last quarter, 6 cents ahead of estimates at $1.18. Adjusted gross margins also beating estimates at 36.5%. And the first quarter revenue estimate forecast from the company, I should say, is higher than estimates at $8.5 billion to $8.9 billion. Analysts had been estimating $8.32 billion here, and it looks like the company's first quarter adjusted earnings per share forecast is also above what had been anticipated. Now, the last time this company reported, it did report numbers that beat estimates, but we still saw the shares fall, but then they've been falling. They were up a little bit today, but in other words, the setup for this report is quite different than the last one, Josh.
For sure, and why we pay attention to Micron, it is, the largest U.S. maker of memory chips, and its chips go into so many important end markets, Drew, that we, of course, talk a lot about on the show. So smartphones, PCs, autos, data centers. Certainly questions on the call, more color from the CEO about what end demand does look like in those markets now and ahead, pricing trends, inventory levels, and of course, with this name, there's been so much excitement about HBM, so high bandwidth memory. That's just super high speed memory, very fast, low latency. What are the trends there as well? That'll be in focus.
Yeah, and the CEO, Sanjay Mehrotra, in the statement talking about the contribution from AI as well. Now, to be clear, Micron, like many of these companies, with the exception of something like NVIDIA, still gets most of its sales from non-AI stuff, right? But AI is growing, and the company says robust AI demand drove a strong ramp of the data center DRAM products, that's one kind of memory chip, and our industry-leading, to your point, high bandwidth memory, HBM. You're going to hear a lot more of that acronym. The other type of memory, NAND, N-A-N-D revenue, that was a record, the company says, and that was led by data center solid-state drive sales, which were more than $1 billion in quarterly revenue for the first time. So again, the message here is that AI revenue is steadily growing for the company.
Yeah, Sanjay Mehrotra goes on to say we're entering fiscal 25 with the best competitive position in Micron's history. Says we forecast record revenue in fiscal Q1 and a substantial revenue record with significantly, he points out, improved profitability in fiscal 25. So very bullish, confident comments there from Sanjay Mehrotra, and you can see investors, at least initially here, responding. Stocks up about 10%.
Yes, they are. All right, we're going to talk more about those numbers on the other side with an analyst. Stick around, more market domination over time coming up.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Micron's fourth quarter earnings coming in moments ago. We're bringing in Dan Morgan now, Senior Portfolio Manager at Synovus Trust. Dan, it is always good to see you. So Micron reports, listen, initial reaction here, investors impressed. This stock is soaring about 11% in the after hours, Dan, but give us your initial response, Dan. What did you make of the print?
Yeah, Josh, I mean, obviously you read the numbers before the break. It was like a beat on the fourth quarter of 24, and then everybody was really hanging their hat on the guidance, right, Josh and Julie? And it looks like a big beat on revenue in terms of expectations coming into this first quarter of 25. Not only that, earnings on adjusted basis were above expectations. So, you kind of hinted about this before, and, looking at these just highlight numbers, it does appear that they are beginning to see a real good benefit from HBM, which of course is the high bandwidth memory that's used with the AI chips. So we're coming out of a down cycle. We've had a couple good quarters, and now we're getting this AI top over the numbers. And it looks like they did gain from that. And we're going to get more color on the conference call. But just from the initial top line numbers, it looks really positive.
There has been a little bit of skepticism on that point recently about where we are in the cycle, about whether we're really coming out of it, about whether pricing was really going to improve. Because, we talk a lot about the HBMs, but most of what Micron sells is not that. It's other types of memory for other uses. So do you think this sort of puts some of those concerns to rest?
A good question, Julie, because if you look at their core markets, which is data center, smartphone, PCs. Smartphone and PCs aren't doing that great, right? They're just starting to get out of the hole. And you have other applications, industrial, auto, and so forth. And you're right, if you look at DRAM pricing in terms of spot pricing, it's just kind of leveled out. It was coming down, now it's just slowly going up slightly. But you're right, their main markets, which are, across the board, there's flash memory and there's DRAM chips just in about everything, is still kind of muted, right? It's still trying to get going. So, if you were to take out this AI component in the data server space, we probably wouldn't be talking about it, right? Because it's just kind of just slowly unthawing. So you're right. Their core markets, you could still raise a question that, it may take a couple more quarters for that to get back on track.
So let me ask you, Dan, because the conference call, starting shortly here, let's say you had the chance to ask CEO Sanjay Mehrotra a question or two. What would be top of mind for you?
Well, you know what, Josh, it's all going to be about HBM, right? It's all going to be how much of an effect. And I guarantee on the conference call, they're going to ask the same question over and over 10 different ways, try to get them to say something a little bit different. But it's all going to be about how much of effect are you seeing from demand for the high memory chips as it relates to AI? We know a couple things, Josh and Julie. We know that those chips are currently coupled with NVIDIA's Hopper 200 and also the Grace Hopper 200. We know that NVIDIA has come out and announced that for the new Blackwell 100 chip that comes out this October, these are their AI chips, they will be coupling it with the high bandwidth memory coming from Micron technology. So with these new chips coming out and the momentum continuing to gain, everyone's going to be trying to create a mosaic. How much of a positive effect are you getting from this? What are you seeing? There are some people that think that we'll do $2 in incremental earnings in fiscal year 25, all based on HBM, the pickup. So it's all going to be about how much of a positive effect are you getting this, like NVIDIA did back in that quarter last spring when they had that huge splash with that huge AI number in their data server segment.
Dan, I want to bring you some more headlines that are just coming out that may be from a media interview just talking about, or a media call, where Micron sees that HBM demand going. So the company apparently reportedly sees HBM DRAM market of over $25 billion in 2025, and that its HBM is sold out for this year and next, and that pricing is set. They're also saying they see unit growth in PCs in 2025. How does that comport with what you've been expecting?
Yeah, Julie, that's pretty much in line with what I was hoping for. So that would be perceived, I believe, as a very much of a positive. There was a lot of people who did think that the PC market would rebound a bit going into 25. It's been pretty lethargic ever since the big jump that we saw during COVID. Everybody, working from home, buying a new PC, laptop, and then it kind of dive down after that, and now we're starting to gradually kind of improve. So based on those headlines that you just gave me, it doesn't change, I think right now in terms of bull case about Micron and what they're doing and this whole effect that we're getting from AI.
All right, Dan, thank you so much for that quick reaction as we see those shares climbing here. Good to catch up with you.
Thank you, Julie.
Well, as the artificial intelligence boom continues to grow, so does the strain on electrical grids across the country. As a result, clean energy has been making headlines. On Friday, Constellation Energy announced it is reopening 3 Mile Island in Pennsylvania to sell nuclear power to Microsoft for the next 20 years. And OpenAI is pitching the White House on an unprecedented data center build-out. What does this all mean for investors? Let's take a closer look with Eli Horton, Senior Portfolio Manager at TCW, who runs an ETF that invests in some of these energy sources. Eli, it's good to see you.
Good to see you too, Julie.
So that 3 Mile Island headline was very interesting. Do you think that we're going to see a lot more of that? And the long-awaited sort of rekindling of nuclear power, is data centers what's going to be the thing that finally unlocks that?
So the short answer is yes, but I'd be remiss if I didn't kind of give some context to that. So we think that we are facing an impending power shortage in the U.S. The situation has changed dramatically. Over the past 2 decades, power consumption has been basically flat in the U.S. That is now rapidly changing, and over the next 3 decades, power demand is going to approximately double. We are electrifying our economy, electric vehicles, we're bringing manufacturing back. And so the fire was already lit, and now AI and this insatiable demand for compute and for data centers has just poured gas on that fire. So we're seeing a significant shortage in the infrastructure and the power generation to meet this demand acceleration. What does that mean? It means we've already seen 2 of these hyperscaler announcements contracting for nuclear power generation capacity. This is reliable 24/7 power. We think there will be more ahead. We think nuclear is a particularly interesting fuel source at this time.
Let me ask you, when Julie says 3 Mile Island, I'm sure there's some viewers, raise some eyebrows when you hear that, right? I mean, how do viewers, investors, how do your clients, how do you tell them to think about risk when it comes to nuclear power?
I mean, look, there was a tragic accident. We have a long history of operating nuclear power plants safely in this country. There's 94 generators, 94 reactors, I should say, up and running now. The problem is that we have not built enough of them. There has only been 3 reactors brought into operational capacity since the 2000s. That's just not enough. And so now you're seeing 3 Mile Island being brought back. There's Palisades in Michigan that may be brought back online. There's a large plant, Diablo Canyon in California, that got a 5-year extension. It's because nuclear power is carbon-free, it's 24/7, it's reliable. Hyperscalers need reliable power, and they're paying a premium for this. So both Microsoft and Amazon in their deals paid over double the prevailing market rate for this type of power. Candidly, we think there is demand for natural gas generation as well.
And so, what is the best way then to play this? Do you buy, Constellation Energy is the company that Microsoft contracted with in this case. You guys in your fund own a lot of utility companies, but you also own a lot of fossil fuel companies. Mm-hmm. So are you just sort of hedging your bets, and is it like everything? They're going to need to draw from all kinds of energy sources.
So it's definitely not everything. So NetZ is an investment strategy focused on the energy transformation. One theme inside the portfolio is power shortage and the need for capital investment in our grid. And so we look throughout that ecosystem, all the way from power generation to the transmission and distribution, and then the electrical and software businesses at the data center level as well. And so we look for ideas across this system. We run a very concentrated portfolio, about 25 investments. So we own Vistra and Constellation on that power generation side. We own companies like Vertiv that are providing power management and cooling management inside the data centers themselves. Our work is to go throughout this system, do very deep research, and try to surface the small handful of winners rather than a spray and pray, own everything type of strategy.
What about Vistra though, Eli? I mean, its stock it's a monster. It's up like 200% this year. That seems to be baking in a lot of good news.
It is. We've owned it for a couple of years. They have a very large nuclear asset called Comanche Peak, which we still think is undervalued today. They have a very attractive natural gas portfolio. Numbers have gone up quite a bit. We still think the company has a great runway ahead. that's reflected in it being a large position for us.
I also want to ask you about some of the more experimental nuclear plays that are out there. There's one startup, for example, called Oklo, if I'm saying that right, that came public through a SPAC. And there's this new frontier of small modular reactors, sort of what are thought of like mini nuclear plants that go next to a data center and just provide energy to that. I don't think any of them actually exist yet, but there's talk that that's going to be the next thing. Do you invest in that yet? How close are we to that? How are you thinking about it?
So we research it, we study it, we're not invested in it. I think the potential is exciting, but it's a ways out. It's probably at least a decade out for SMR technology. So this really highlights the point. We're looking for these new clean sources, SMRs, certainly wind and solar, but those two pieces are intermittent, and we need reliable baseload power generation. That comes back to the nuclear fleet that we have today that is worth a very high price, and natural gas. And so, yes, we look at these innovative technologies, but we think that right now the opportunity is in some of the older type assets.
And then one more quick question. Do you buy uranium? Do you buy something like a UEC, which has been kind of hot, if you think nuclear is going to have more of a comeback?
So we could, we haven't. This is one thing that we try to do is, I described that system earlier, power generation all the way through to where it's consumed and the components that are involved with that, the electrical components. We look for the businesses with the largest competitive advantages, and I listed off a few earlier, like Vertiv or Vistra, and which companies should accrue the profit potential, the profit pools, and what's priced into those stocks. So we could own uranium, we don't. We currently have about 6 or 7 companies that are tethered to this theme that we're particularly excited about, but we're always looking for new ideas for investors.
All right, when you have them, come back, Eli, fast. Thank you so much.
Thanks,
Appreciate you joining us. Time now for What to Watch Thursday, September 26th, sponsored by Tasty Trade. Starting off with the Fed, we're getting a big batch of Fed commentary tomorrow throughout the day from multiple Fed officials, including Fed Chair Jerome Powell and Fed Governor Michelle Bowman. Bowman cast a lone dissenting vote on the Fed's decision to cut interest rates by 50 basis points last week. Bowman reiterating yesterday that despite recent progress, inflation remains a concern.
Moving over to housing, pending home sales data for August coming out in the morning. Economists forecast sales will rise by 1%. This coming after July sales fell by 5.5%. It's the lowest reading since 2001. We'll also get new weekly mortgage rate data in the afternoon.
And finally, we'll be getting some more earnings from Costco, Accenture, and CarMax, among others. Costco reporting fourth quarter results after the close. Analysts expecting to see same-store sales grow, giving us more insight into the health of the consumer.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Investors taking a breather on Wall Street. The Dow and S&P 500 pulling back from all-time highs, with most sectors coming under pressure. Plus, Vice President Kamala Harris laying out more for economic policy on the campaign trail. She just wrapped up a speech in Pittsburgh where she still was somewhat light on details, but made an appeal to more moderate voters. We're going to take a closer look at the policy plans from both Harris and former President Trump straight ahead. Plus, big investments and growth in artificial intelligence means more demand for power. We have a closer look in our chart of the day. Presidential candidates Kamala Harris and Donald Trump voicing differing visions of the state of manufacturing with opposite views to help the industry. Yahoo Finance's Washington correspondent Ben Werschel joins us now with more. Ben.
Yeah, hey, so as you mentioned, Kamala Harris just wrapped up a 40-minute, kind of what the campaign is billing as a major economic speech. So I have four sort of quick takeaways for you on kind of what she laid out. The first one, as expected, is a focus on manufacturing. She called it the third pillar of her opportunity economy. She'd previously laid out the first and second pillars around cost of living and small businesses. So when she talks about the industries broadly, without a ton of detail, about that she would be focused on: biomanufacturing, aerospace, AI, quantum computing, sectors like that she would make it sort of the government's business to help out, sort of as the Biden administration has done on chips and green energy in the last couple of years. So that's the first. Second is some business-friendly ideas that I think may not resonate with voters, but I think CEOs, and it's clearly an attempt to kind of give Mark Cuban and folks like that ammunition to defend her. One that jumped out at me is permitting reform. Regular folks don't know that, but businesses, that's a real big issue. It's been a giant thing in Washington for the last few years of kind of getting projects done quicker. And so she hit that and made sure to focus there, and also things like apprenticeships. So number three, a little bit on trade, just because I know you have a trade guest coming up right behind me. She did do sort of what she normally does and slammed Trump. Primarily, she talks about a $4,000 national sales tax of his tariffs, but she also sort of positioned herself in slightly new language as a China hawk. She talked about how I'll never hesitate to take swift actions if China does some of the things they've been doing in recent years. Dumping steel, issues like that, unfairly subsidizing shipbuilding, issues like that. She said this strong measures was the term she used that she would take. So that kind of ties into sort of a little bit of how she'd approach trade. And then the last one for you is kind of, there's these policy ones, but I think the word of the speech was pragmatism. This is, like, as you mentioned at the top, this is kind of an appeal to moderates, to swing state voters who, in Harris's campaign view, kind of want her to be talking about this as much as the policy specifics. They're not going to change their view based on which industry she mentions here or there. They want her to sort of be describing these issues she cares about. And so the speech was kind of an attempt to kind of give a overview of her policy and sort of touch through everything she's been laying out in the last couple months. Ben, thank you. Appreciate it. Thanks much. For more on today's comments from Vice President Kamala Harris, we want to welcome in now Christine McDaniel, Mercatus Center Senior Research Fellow, and someone who has had many different roles as an economist in the government. Christine, it is good to see you. I want to start on trade and trade policy, Christine, because a lot of your career has been focused and thinking deeply about those issues. As my colleague Ben Werschel was pointing out, of course, Harris giving a speech today, maybe gave some details about how she thinks about trade and trade policy, position yourself, as Ben was saying, as perhaps more of a China hawk, criticizing Trump's tariffs. But what is your sense broadly of how you think she is thinking about trade and trade policy, Christine? How would you assume it could compare and contrast with Biden, if at all?
Well, thanks, Josh. It was a really nice speech to listen to. She's a lot of fun to listen to, a lot of laughs. But light on details. She says all the right things. She'll say things like, she wants an opportunity economy, an innovation economy. But then, it's like whiplash, and she talks about Pittsburgh as being the steel city. And I was just in Pittsburgh. Pittsburgh is, it's reinventing itself as an innovation hub. So it's not clear. She talks about wanting to do one thing, but then you look at what they've done. they've kept all the Trump tariffs and added to them. So it's I really don't know. I mean, that's the thing. I mean, at least she's not talking about a 200% tariff. on John Deere equipment like Trump is. But on the other hand, she has kept all the Trump tariffs, and she talks a lot about subsidizing. So with Trump, it's, the tariff solves everything. With her, it's more like subsidies and tax incentives and price controls. So, but she says all the right things. But but in terms of the policies that we've seen, just as protectionist as Trump.
Let me ask you, Christine, when you talk about tariffs, in your opinion, are tariffs an effective, or can they be an effective policy tool?
Well, tariffs have never been an effective way to get companies to come back to the U.S. By themselves, right? I mean, you just look at automobiles, for instance, right? So back in the 80s, we did a whole bunch of tariffs and quotas. We got Japan to agree to voluntarily restrict their exports to us. And then what that did is over time, Japanese companies, other foreign automakers wanted to come to the U.S. and build in the U.S., to jump over that tariff wall. So, you could argue that that was a success, at least for the first few years. But then over time, what's happened is that really now the only thing that the U.S. automakers do really are really competitive in and make all their money in is on the small trucks, right? And that's because of the 25% tariff that's still there. So, it can work in the short run. In the long run, it's not. I've never seen it as a viable long-term strategy for competitiveness. But politicians still really like to tout them as a popular tool.
A concern for Americans, Christine, I think really across political aisles is, jobs getting shipped overseas. And it's interesting to watch politicians try to address that in different ways. You can look at Biden sort of trying to incentivize the creation of more high-level manufacturing jobs here. Of course, as you mentioned, Trump, with tariffs, talks tough on John Deere as he did. It's complicated. It's thorny. I'm wondering, what do you think some appropriate, effective policy prescriptions really are?
Well, look, she says all the right things in terms of what she really wants, right? She says she wants an opportunity economy. That is great. For an opportunity economy, it's the tried and true things that all those economists that she talked about that that like her overall approach, at least in terms of compared to Trump's tariffs. It's secure property rights. It's a good rule of law. It's market-based competition. No price controls. No clawing back patent rights. Things like this. It's an innovation-friendly, business environment. Deregulation. She talked a lot about that. That was great. And it's good institutions and good governance. We need to give our institutions the independence. Our independent institutions, they need to keep that independence. The Fed, all the other independent and then independent agencies that we have in the country need to keep their independence to do their job and stay away from mission creep. We have not really seen that well under the Biden-Harris administration. We've seen the Federal Trade Commission start to get into other areas that have that's been a real damper on mergers and acquisitions. We've seen other agencies try to put their hand in price controls, and that's been really concerning. But what she says, she says one thing, but yet what we've seen the administration do is another. But who knows? Maybe with a Harris administration, she might take a different approach.
All right, and if she does, we'll have you right back on to discuss, Christine. Thank you so much for joining us. We really appreciate it.
Thank you.
Coming up, a new shark is entering the tank for season 16 of the ABC show. We're speaking to Daniel Lebetsky on the other side. Stick around, more Ask for a Trend still to come. You might want to grab something to snack on for this next discussion. The snack food industry represents 27% of all food and beverage sales in the U.S., with snack sales totaling nearly $70 billion. And join me now is someone who knows a thing or two about the industry. That is Daniel Lubetsky, Kind Snacks founder and Builders Movement founder. And he's also the new shark investor on ABC Shark Tank, replacing longtime shark Mark Cuban. Also joining us now is Yahoo Finance's Alexander Canal. Welcome to you both. Daniel, great to see you.
Thank you. Just to be clear, nobody can replace Mark Cuban.
No, we never say that.
Insane.
He's moved on to the next chapter. That's how we'll say.
He's still with us this season, and it is so fun to be with them. Like, I learned so much, and they're like, Mark is like a incredible computer. He processes like at a very fast speed, and everybody there is honestly irreplaceable.
Let's say we're doing it. Let's do a trial Shark Tank. Right? Let's say I'm an entrepreneur.
You're gonna give me a pitch?
Let's say I give you a pitch. I'm just curious, what do you actually listen for in pitches? Are there certain themes, certain trends, Danielle, you want to
I think
hear?
like almost all human beings, you develop a sixth sense to get a feeling for the person's authenticity, what's behind the words. And for me, that's the most important thing. Like, are they real? Do they have integrity? That's really the most important, because if you don't have that, I'm no longer interested. If you have that, I still want to make sure that you have a great product or service, that there's a unique selling proposition, that it's got potential, that you demonstrate the ability to be tenacious, but also creative and think outside the box. Shark Tank companies are at a very early stage, so the only way they're going to defeat the much bigger giants is by outwitting them with creativity. So I look for that also.
What's the biggest mistake someone could make when pitching you?
I think not being frank. Like, if you are caught with a tough question that you don't have an answer to, or that the answer is not pretty, you're far better off showing introspection and the ability to be self-reflective and say, this is not where I'm strong, this is where I need help, or this is what I've learned. In my opinion, in life, not just in Shark Tank, in life, the people that I want to hire and that I want to work with are people that can grow. People that grow are people that can evaluate themselves. And we have a very big danger today. Very, like my accent, sometimes even I notice how much of a schmuck I am. Very big danger where we're so attached to social media that the algorithms are telling us what we want to hear rather than what we need to hear. And we'll start thinking that we're smarter than we really are, that we have all the answers. It's really, really important to take the time to self-reflect every day, every week, every month, every year. What can I do better? What's important to me? What are my priorities? How can I improve? I think it's a very important value.
You mentioned social media, Daniel. One thing I see, this trend I see on social media, I'm very curious to get your take on, because nobody knows snacks in the food industry like you do. This trend of this sort of backlash against ultra-processed foods, right? Yeah. This is a thing. I mean, Robert F. Kennedy Jr. talks about it. Yeah. Regardless of what you think about him, there's a guy with a big megaphone, right? Yeah. How do you think about that backlash, that trend, and what it ultimately could mean for the snack industry, the food industry?
In my opinion, Josh, it is very real, and it's not sufficiently discussed. I mean, over 50% of products lead with an overly refined carbohydrate that's empty of nutrition, like refined flours, refined sugars. A ton of products have artificial dyes, artificial sweeteners, things that are carcinogenic or just not great for you. And we don't do enough to educate the consumer. Like, we in the United States have such an explosion in inflammatory diseases, much more than in other countries that are developed, because we have much lower standards for what we allow ourselves to put in our bodies. And I think it's a very big issue, and I think it's going to continue growing, because the delta between more wealth and still more inflammatory diseases, at some point people are waking up. It's not the right way for us to build our society.
And related to the trends that we're seeing in the food industry, outside of Shark Tank, you also have the startup incubator Camino Partners, which is actually an early investor in Kava. That's a company we've talked about a lot since that debut. It's up nearly 200%. What makes Kava?
Far more. It's like
since the max, right?
Since it came out, like we were there a few rounds before it went public, and then we're very long-term holders. It's an incredible concept because it's Mediterranean food. They don't really have a competitor. They can go into suburban places, into urban places. They have an incredible runway, and they really are able to meet the occasion. When our kids go to a sports meet afterwards, we can eat kava at home. It's a really, really delicious an approachable, really full meal, and very nutritionally rich, and the company's just exploding.
And how does a company like that, and really some of those other fast casual names, weather inflation, weather economic challenges? Because we've seen that hit some of these other fast food casual places.
Alexander, for me, my experience is that if you have a great product or service and you're at a growth stage, these things don't phase you. It's not to say that inflation is not terrible for our economy and for households and consumers, but when a company's on a fast growth phase, like Kind, when we launched it, and by the way, I made tons of mistakes before Kind, 10 years of 2 steps forward, 2 steps backward, but when Kind drew the lessons from the mistakes from my prior decade, it was just like a juggernaut. And we went through the financial crisis as we kept growing triple digits, cash flow positively and profitably throughout 10 years of growth, including we're established with John Leahy as my partner.
Yes. Shout out John Leahy. I grew up with his daughter, Devin, one of my best friends, and we had that mutual connection.
And John Leahy is someone that we need to celebrate, not just because of it, because people don't talk enough about the people that actually build everything. Like, to a Daniel Lubetsky, there's always a John Leahy, and he was like my yin to my yang. He was my partner that kept the train running. I was creative. I was, I think I can say, I don't have false humility, inspirational and creative and think outside the box. But John was the guy that kept me focused, and it was an incredible partnership. And in almost every journey, you have those type of duos. And if it wasn't for John, Kind would not be we built it, and it was an incredible journey. But the financial crisis didn't stop us. We kept growing because if you have the right culture, the right products, and you set your brand guardrails and follow them, you keep your promise, the Kind promise in that case, I think you can get through a lot.
All right, great advice. Great advice for those entrepreneurs you're about to meet too, Daniel.
Yeah,
Thank you so much for joining the show. Appreciate it so much.
Josh. Thanks,
Thank you, Ali, as well. Stick around, more Ask for a Trend right on the other side. OpenAI reportedly now looking to shift away from non-profit control. It's according to Reuters, company turning its attention to the for-profit business, and a key executive is also stepping away. Yahoo Finance's Dan Howley is here with the very latest. Dan.
Yeah, this is a big change. Essentially what's happening here is OpenAI is reportedly looking to go from being controlled by its nonprofit side to for-profit. So it would be kind of a social responsibility company, similar to the way that XAI is set up underneath X. And so it's a huge kind of twist as to what this means for OpenAI. I think the real question is, what does this mean for Sam Altman? What does this mean for Microsoft, for Apple? Microsoft because it's invested so much, Apple because it's investing some as well. And then what does it mean for the AI safety side of things? The reason why there was this whole nonprofit originally was because they could kind of pull the plug at any point and say, look, this isn't safe. We need to have a kind of disconnect between what investors want and the safety of AI when we're trying to go towards this artificial general intelligence, which is basically supposed to be AI on par with human thinking to a degree. It's not Terminator, but it's or necessarily malevolent. Although Terminator, he was good and bad. But I think that's really the bigger question is what it's going to mean for the safety.
And why
aspect.
now, Dan?
It seems like OpenAI doesn't exactly seem like the I would say most stable place at this time, right? We just had the CTO abruptly announce her exit today over Twitter. I was looking, or X, whatever.
Interesting.
I haven't seen anything from Sam Altman on that yet as far as Twitter goes, and you would think that he would say, oh, we're sorry that she's leaving, it was great having her as kind of an immediate response. They also just announced new models recently. It's and obviously there was a tumult with Altman being ousted by the nonprofit side and then being brought back in and then having that board reconstructed. I think it just kind of speaks to the broader sense of this company trying to push its limits, and now that it's had so many investors from the likes of Microsoft and Apple, everybody's trying to get a return on that, and you can't do that. But there's a cap on how much investors can get in returns for this company. So I think they're trying to kind of undo that nonprofit side and turn it full for profit.
Big story, big personalities. Dan, thank you so much. Appreciate it. For our chart of the day, we're looking at electricity consumption from U.S. data centers. How much will they use? Yahoo Finance's Julie Hyman join us now with a closer look. Julie.
Short answer is a lot, as we know. The longer answer is it depends on the projections over the next few years. But in any case, we know it's going to go higher. We know that because of all the construction of these data centers and OpenAI among them, right? Which has just talked to the Biden administration about building more of those data centers. So here is what we have seen thus far. And you see that this is measured in terawatt hours. So this is the large quantities of energy consumption is what we're talking about. There's been a little bit of uptick after really steady energy consumption for many years. That started around 2020. In part because of data centers, among other things. And then if you look at the projections, and these are coming to us from the Electric Power Research Institute, it kind of depends on what kind of data center growth we are going to be seeing. They looked at using low, moderate, high, and higher growth scenarios for electricity consumption based on how many more data centers we might get. So in the smallest scenario, you get a 3.7% gain. In the highest scenario, you get a 15% gain on an annual basis going out through 2030. Any way you slice it, you are going to have an increase, which comes back to the theme that we've been discussing a lot today. Goes back to that Bain report that we've been talking a lot about AI growth and what that is going to result in terms of the U.S. economy. We saw that play out not just today with U.S.-based power companies and stocks rising, but year to date, a big increase in those stocks. We earlier talked to Eli Horton, who runs an ETF that invests in the energy transition, and he talked about not just data centers as being a source of this demand, but other aspects of the U.S. economy as well.
So we think that we are facing an impending power shortage in the U.S. The situation has changed dramatically. Over the past 2 decades, power consumption has been basically flat in the U.S. That is now rapidly changing, and over the next 3 decades, power demand is going to approximately double. We are electrifying our economy, electric vehicles, we're bringing manufacturing back. And so the fire was already lit, and now AI and this insatiable demand for compute and for data centers has just poured gas on that fire. So we're seeing a significant shortage in the infrastructure and the power generation to meet this demand acceleration.
So that's the place where he's trying to invest through that fund. But I mean, if you look at this 15% through 2030, I mean, It's obviously not even on the chart if you're talking about 50% over the next 3 decades here, but still, again, any way you slice it, this is something that is going to expand, and the infrastructure is going to be necessary to expand along with it, Josh.
All right, Julie, thank you. That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.